Good evening to everyone, all the participants who have joined this masterclass. Just before we get started, let me just set the context. As you know that at ThinkAg, we continuously look for solutions for the challenges that the AgTech ecosystem is facing. So in that series, we came across that one of the challenges which a lot of AgTech entrepreneurs face is access to debt, right? And all of us know that is very important to drive scale of your operations, and it also helps to grow without diluting your equity. Though we see a significant increase in the venture capital looking to invest in AgTech, I think debt continues to be a challenge, and primarily because of the fact that conventional debt instruments require collaterals, and a lot of agritech startups don't have capacity to give those collaterals. So clearly, we need to look for innovative solutions when it comes to debt financing. And to discuss those solutions, we today have partnered with one of the leading players in the debt space, which is Caspian Debt, and we are very fortunate to have Avishek Gupta, who's the investment director and head of Caspian Debt. Avishek has enabled debt investments in more than 150 early to growth stage companies. As we all know, Caspian Debt is a leader to social enterprises and startups operating in multiple sectors, including food and agriculture, clean energy, energy efficiency, affordable housing, healthcare, financial inclusion, and education. So we welcome Avishek to this masterclass. Before I hand it over to him, I also want to thank our friends at Rabobank, especially Arindam, who gave us this idea that why don't we do this masterclass. So he kind of conceived it, and he got Caspian and us together to conduct this masterclass. So thanks, Arindam, and all the Rabobank team for your support. So with that, I'll hand it over to Avishek. Avishek, over to you.
Thanks, Emil. Thanks, ThinkAg team, and of course the Rabo Foundation team. Good evening and welcome everybody to the session. I'll just share my screen in a bit, and I'll start. Okay. Abhijit, is it possible to share the screen? Yeah, thank you. Okay, so yes, so the session today is it's called as a masterclass, and we're going to talk about debt financing to AgTech startups. And before I start, I want to make a promise, and the promise is that by the end of this session, all of you who have joined this session will have the knowledge to build a more capital efficient company, meaning that you will be able to achieve your long-term goals of your company while retaining slightly more control over your business decisions, and probably retaining a little bit more of your financial benefits once your company succeeds. So I'll focus on two main areas. One area, of course, that I'll start off with is about how to raise debt from alternate or new age sources when traditional sources of debt are not able to meet your debt requirements, which is what Hemendra hinted at the beginning of the session, that while there are debt providers, given the nature of AgTech companies, it is not often seen that traditional lenders are able to meet the requirements. So Caspian Debt being an alternate lender, and us having the experience of funded about 160 companies in total, out of which I think about 35 are AgTech companies, we seem to have got some understanding about how to go about raising debt. And I will share some of that knowledge combined with some of the knowledge that I've gained from other sources, and put it in the perspective of how the companies or AgTech startups can look at raising debt from sources like that of ours, not just Caspian Debt, but so many other people. Secondly, what I'll try to cover is the other sources of debt that are available. Though it is understood and known that the traditional or the other sources of debt are not easily available, in various circumstances, they are actually available and suitable if you work towards them. So I'll try to kind of simplify as to when you should look out for them. This session...
Avishek, can you make it full screen? Yeah. Go ahead.
So, and the slide reads who's the session for, right? Or is it something else? Hemendra, can you confirm if the slide says who is this?
Yeah, we can see the slideshow. Yeah, thank you.
So this session is for those entrepreneurs who want to build professionally managed businesses that seek to grow fast by raising external capital because their profits may not be sufficient to achieve the speed of growth that they want to achieve. This session is also targeted to those who are not willing to trade control of the business decisions for access to this additional capital that they need for growth. There can be companies that may not want to or need to or need not grow as fast, and they may not need external capital. So whatever I say may not apply to them. So before I begin or talk about how to raise debt, I think one of the key things that I would want to highlight to everybody is that equity and debt, both are external forms of capital, and both serve a very important purpose in an AgTech company. However, the nature of financing, even though they are both money, is quite different. And the basic suggestion or advice that we give to AgTech companies or startups in general is that you should raise debt only when you have predictable cash flows. For every other situation, equity is the right solution. So the purpose of this session here today is at no point of time to say that you should not raise equity. The point is you should raise equity and blend it with debt if it is available to make your company more capital efficient. To give a very simple explanation of where to use equity and where to use debt, equity is long-term capital without any pre-agreed schedule of repayment. So it doesn't come with a repayment schedule, but there is a general understanding of when the equity investor would like to exit. But like I said, it doesn't come with a prefixed schedule. Now, what that helps in is that when you have investments to make that do not lead to immediate cash flows, or there is an uncertainty around the cash flows, or when it will get generated, that is the time you use equity. With debt, the moment you sign up on a debt transaction, you're contractually required to repay under a fixed kind of a pre-agreed schedule. And there may be a lot of flexibilities in the schedule, repayment schedule, but it is a pre-agreed repayment schedule, meaning that whenever there is a repayment date and a repayment amount specified on that date, you are contractually obligated to repay that amount on that date. Hence, the use of debt should be only in cases where cash flows are more predictable. So to give you a kind of an idea of the differences, equity should be used when you are, for example, using the money to develop a new product, file patents, or even the first cycle of revenue generation for your product or service. The debt product, however, is better used when, for example, you have got the product, it has sold the first cycle, and you are ready to scale. There is existing contracts available with you. And this applies to B2B companies, for example. In all those cases where you know that, okay, I have sold in the past and the money will come, in those kind of situations, debt should be used. Now, having said that, it is not easy to get debt because traditional sources of debt do not provide funding to AgTech startups if your loan requirement is more than 1 crore. under situations when you do not have a mortgage collateral. So if you need a loan of more than 1 crore, which is what fast growing growth stage startups need, you need to have mortgage collateral or a resaleable asset that you can use to give as collateral to take the loan. In some cases, for example, in a new form of capital called venture debt that has come up, they look to fund agtech companies or startups. That's why they're created. But what we've seen is that those lenders also provide funding in a very specific situation. And the specific situation is that you have a reputed venture capital investor already with you. So if you are a bootstrapped company, or if you have an equity investor who, at least in the opinion of the venture debt provider, is not reputed enough, they will typically not fund you. And there are reasons for all of these situations. And lastly, and probably most commonly, if you are not profitable, traditional lenders will not obviously fund you. When I say traditional, I'm talking about the normal banks and traditional NBFCs. And I'll explain this in the later part of the presentation. But what you will oddly see is that some lenders evaluate an asset, which may be a mortgage collateral, which may be a equipment. Some lenders evaluate the counterparty, and some lenders evaluate your investor. But very few lenders evaluate the core business itself. All these lenders do evaluate the business, but they still want to have another fallback option. That fallback option typically is in the form of a mortgage. Sometimes it is in the form of a strong counterparty buyer. Sometimes it is in the form of an equity investor. And a lot of agtech companies may not have access to any of these, given the nature of your business, or sometimes you may have one, but you may not have others. And that one criteria does not allow you to raise a lot of capital per se. So what do? The one key thing that all of you have is that you have information about your business, information that can establish that you are a solid business that can be provided debt. For that, you need to be willing to share that information with the lenders who take decisions based on the core business, who take decisions based on the verifiable information that the companies are providing to them. Because for them, they don't have a mortgage to fall back on. They may not have profitability of the company to fall back on. They may not have a reputed VC investor to fall back on. So the only thing that those kind of lenders can fall back on is the data on the company, verifiable data. And that is where entities like Caspian Debt plays a role. We try to evaluate companies based on the actual or the core business potential or the core business performance. And I'll give you a little bit of a detail on what aspects Caspian Debt looks at closely. And once I'm through with this, I'll also cover or give you some details on what the other sources of debt look at as well. Because at the end of the day, if it is still not clear, what I'm trying to get at is that for different situations and for different stages of life of the company, there are different lenders or types of lenders or products that are available. As an agtech company, you are better off being aware of all those options available and approaching these solutions depending on the situation that you are in, because that is going to help you get access to the right kind of debt at the right time. So going back to the types of lenders who evaluate the company per se and don't lend based on mortgage collateral or some other asset or profitability or venture capital investor, because a lot of agtech companies we know don't have all of them. or do not meet some of the criteria. So what do we look at? What does Caspian Debt or entities like Caspian Debt look at? We look at broadly 4 areas. There are a lot of details into this, but broadly, if I categorize the different things that we look at, it consists of the quality of the governance and the management. We look at the business and the operations risk that the entity or the AgTech company faces. We look at the quality of the processes and systems. And of course, we look at the financial performance. Now, if I am to dig a little deeper into this, like I said, there are several points. And if you look at, for example, the evaluation framework that Caspian uses, we have 65 to 75 parameters that we use, which kind of covers different aspects of all these points that I mentioned. But I'll kind of talk about a few of them, which will give you an understanding of what we are looking for. The first thing is data transparency. What we expect is that the company has to be able to share MIS reports going back at least 12 months. That kind of an MIS report expected to cover details like, say, for example, revenues, expenses, your receivables, track record, and so on. And why is this important? It is important because, like I said, lenders who are considering to lend without mortgage collateral, without 3-year profitability, without even in a situation when the company is bootstrapped, it is necessary for us to get something else, and that is this MIS, which is very important for us. It is also important that some of the data that you submit is verifiable. So, for example, and at least 1 year of audited financials with revenues, operating revenues in the business that you are in, is necessary, because without that, it's very, very difficult to verify the actual performance of the company, or you wouldn't have enough track record. Luckily for us today, a lot of developments have happened in the verifiable information area. So today, for example, you can share your bank statements, or you can share your GST statements with lenders like us and say that, look, this is how you can also verify whether my MIS is correct or whatever I'm claiming is correct. The third thing is revenue certainty. Like I mentioned right in the beginning, that you should take debt only when there is you have cash flow certainty. The first step towards cash flow certainty is revenue certainty. And that comes from, for example, for B2B companies, it is existing orders in hand and past track record of having executed on those orders and the counterparty having paid you on those orders. If you have that kind of a track record, having new orders in hand gives, indicates revenue certainty. In an ideal situation, operating cash, I mean, the company has to be cash flow positive, because only then you can repay the loan. This is especially necessary for bootstrap companies. However, in case of venture-backed companies, venture capital equity-backed companies, those kind of companies take an kind of a strategic decision, or what you call a strategic choice, to focus on growth first rather than profitability in the earlier days, because they want to grow fast. That's how the venture capital investor will reap returns, and the entrepreneur will also reap returns. Now, that's a very different strategy from the traditional way of running businesses. So these companies may be cash negative. So should they raise funds? The answer is, should they raise debt? The answer is yes, but only if, and here is the detail, that only if the unit economics of the company or the business model is established. If your unit economics is not established, your business model is not clear, in that kind of a situation, even if you have equity backing, you should not look to raise debt, because without an established business model, without an existing revenue certainty, there is no way you can predict when you will get cash flows. And hence, in those circumstances, you should not borrow. But if you have a proven business model, unit economics are proven, but you're still making losses just because you are spending much more, meaning that you may be a 3 crore, 5 crore to annual revenue company, but you've hired a very senior marketing person, or you are spending money to build technology that is more appropriate for a 500 crore turnover, but you're making that investment or expense today because you know that you will get to that 500 crore turnover within 2 years or 3 years. And the venture capital equity investor is ready to kind of fund that cash flow mismatch. In those circumstances, you can raise debt as well. So you need to be both unit economics proven and you have a venture capital investor backing you. In those kind of situations, you can take a loan without being operating cash flow positive. Viability of the business in the medium to long run is important. So for example, gross margins of the business, the kind of buyers you have, how much diversified the buyers are, the quality of relationships with the suppliers, and of course, the competitive landscape is important. One of the key things that we have observed as far as AgTech companies is concerned is that AgTech companies by design are supposed to be, creating a completely new, kind of exploring a completely new opportunity with the use of technology. In a lot of situations, that opening up of the opportunity to the maximum scale would take some time, because it is about shifting markets, it is about shifting habits, it is about shifting the practices and existing supply chains. That doesn't happen overnight. Now that shift, if it happens, it actually leads to a very big outcome, financial outcome for the startups and the venture capital investors. And that is the reason why they invest. They don't care about what happens in the next month. But if the business with the technology has the ability to disrupt things 3 years down the line or 5 years down the line, they make an investment thinking that because of this disruption that may take 3 to 5 years, I will result in significantly positive financial returns, and I'll also enable myself to get significant, for those who care about social impact, I will also get significantly positive social impact out of this investment. But I don't care whether if I get it tomorrow or day after, because it will come to me 3 or 5 months later. And I need to understand the technology well to be able to say that, yes, it will happen 3 or 5 years down the line. So the equity investor will evaluate the claim that this technology will actually result in the valuation growth. Now, the funny thing with lenders, of course, is that lenders cannot wait for 3 to 5 years. If they have to wait for that long for the money to come back, it means that it's almost equivalent of equity. Lenders want the money to start coming back probably next month or probably the next quarter if there is a moratorium. I mean, they may give you a 3-year or a 5-year term loan, but the money has to start coming back in the next month or the next quarter. In case of equity, they can wait much longer. They can have all the money come back 3 years or 5 years later. Now, what this means, especially relevant to the AgTech companies, is that while you may have a very sophisticated and a breakthrough technology, if it doesn't result in immediate cash flows, or it doesn't result in cash flows 1 month or 3 months down the line, there is no point in selling the the benefits of the technology to a lender. Typically, you should of course mention how it is going to change things in future, because that gives confidence to the lender that this is a high quality business. But if you cannot assume that because of this quality of technology, a lender will lend to you. An equity investor will invest in you because of the quality of the technology. But a lender will lend to you if the quality of the technology is good, plus it results in cash flows in the near future. If it doesn't lead to cash flows in the near future, no matter how breakthrough your technology is, it doesn't really help a lender to take a positive decision. And I'm mentioning this and taking a little bit more time on this because a lot of AgTech entrepreneurs in our experience have are typically very gung-ho about the technology. They find it difficult to understand why, even though their technology is so breakthrough, this lender is so dumb not to consider it. Point is, they're not dumb. They don't get any benefit out of this technology because they want the money back in the next 3 months, starting the next 3 months, even if they give you a 5-year term loan. So I would request all entrepreneurs, AgTech entrepreneurs, to keep this in mind. One big benefit that AgTech entrepreneurs typically have is that the gross margins in the business are typically significantly higher than the traditional agri businesses. That gives a lot of comfort to lenders. One of the other things that we have seen happen, and this is also something that a lot of you have to be careful about, is that the expectation for a tech business is to have solid gross margins. And when I say solid, I'm talking about north of 30% or maybe 25%. If you have gross margins of 10% or 15%, I'm not too sure whether it's a tech business per se, or even if you are a tech business, it is probably viable only at a much larger scale, maybe 100, 200 crores. In that kind of situation, you have to really evaluate whether you are a real AgTech company or you are a traditional company using a little bit of a tech, and make a presentation to the lender accordingly, not to kind of think that a lender will consider me only if I'm AgTech. Moving on. Relevant experience of the promoter is important, meaning that the promoters or the key managerial persons in the company, in our opinion, should have a minimum of 3 years of relevant experience. Now, why is that important? Are we saying that people who come from a different industry are not suitable to disrupt? Because examples say that that is always the case. We're not saying that that is untrue. We're not saying that people coming from a different industry or experience are not successful in this business. They are successful in the business, but are they? Unless they have the experience to make sure that there is revenue and cash certainty in the business, it doesn't help. And typically, that kind of a situation comes with some minimum years of experience. And when I say experience, it could be a combination of both academic experience or work experience. Experience in the same startup for 3 years also is fairly useful, because you would have actually gone through the pains of understanding the same business for which you are raising debt. Credit bureau history of the company and the promoters of the business. So if you have not taken a loan, that's okay. But if the company has taken a loan in the past and there are current overdues or past write-offs, typically no lender would consider lending to that kind of a company. There are some specialized lenders who lend in distressed situations, they may consider, but otherwise, if you have a loan and there are current overdues or past write-offs, it is a bad situation to be in from the perspective of raising further debt. If you do not have loans, that is a better situation compared to the situation that I just said. The same thing applies for the promoters as well. Now, why is it important that the promoters have a good credit score when the borrower is actually the company? The reason why it matters is because the company at the end of the day, especially an early stage, growth stage company, is essentially an extension of the promoter as far as their mindset of repayment of debt is concerned. So in a way, the promoter's credit score is a proxy for how, in all possibility, the company is going to be serious about repaying debt on time. And that is why this score becomes important. Aspects like cash management or credit history. For example, if you are issuing checks for making payments to your suppliers, too many check bounces is actually a bad sign. meaning that either you are not serious about making payments to your suppliers, or you are not able to manage your cash flows, both of which is not a good sign from a repayment of debt perspective. Collections rigor. Now, this is important for AgTech companies because, like I have been saying, is that what I've been saying is that the AgTech companies focus on growth first, meaning they focus on billing revenues. But the company, I mean, there's no point in the revenue if you don't make the collections. If you sell a product or deliver a product to a customer, and that customer says that they will pay you 30 days or 60 days later, and you never get that money, that revenue is useless. And what often happens in a lot of AgTech companies or startups that are focused on growth is that they focus a lot on the revenue, but a lot of the times collections takes a backseat. And the companies that are successful actually have specific people looking at collections on a daily and a weekly basis. So we try to look for companies that have this focus. They understand that booking revenues only is not the solution or end of it. You have to find a way to make collections as well. Otherwise, there's no use. Quality of internal controls, whether you maintain proper books of accounts, financial transactions that you've done, record of your inventory if you have, or receivables, aging, order book, all these, when we ask for it, is it easily available, and is there proof that somebody in the senior management is regularly looking at all these things? It's important. Statutory filings, like say, for example, if you have tax payable or EPF pensions or any other statutory payments that you have to make, are you making those on time, and are you making the filings on time? Both. A lot of you may wonder that, we're talking about ag tech, we are talking about changing the world, we are talking about disrupting the supply chains, we are talking about changing lives, and here I am talking about boring things like credit history, cash management, collections rigor, internal controls, statutory filings. This is so boring. The funny thing is that while it is boring, this is what decides whether your company is going to scale or not, whether your company is going to be that company that is able to fulfill the promise and excitement that you created when you first developed your technology, the promise with which you attracted new customers or employees or investors even. Are you able to fulfill that promise? And you are able to fulfill that promise only if you are a large scaled company. And that won't happen unless you have these boring things in place. So sometimes it actually pays to be boring. And sometimes it makes it easier for a lender to make a loan as well. I'll move on to the other forms of debt. And so what I was talking about till now is the typical way in which lenders like us or lenders like Caspian Debt, who do not look for mortgage collateral, are ready to provide financing up to 15 or 20 crores, are ready to provide loans to loss-making companies, are ready to provide a very high level of flexibility in the product structures. What do lenders like that evaluate typically, and what are the key areas that we look for? So that is what I was describing till now. What I want to talk about is the other options of debt that is available. Like I said in the beginning, the purpose of this session is not to say that equity is not necessary. Equity is necessary. Equity capital is necessary in specific circumstances. And of course, debt is known as it is necessary. What I also said was that there are different kinds of debt products and sources of debt products. As an AgTech company, you should evaluate when any of these situations are there in your company. Your purpose is to get debt for your business because that helps make you more capital efficient. And for that, you should not just evaluate Caspian Debt, but you should also evaluate other options wherever it is it meets your requirement. And there are lots of types of debt available, and it sometimes may sound complicated and difficult to understand. But if I really simplify everything, and this is how I look at things, and different people may have different ways of looking at this, but if I simplify all the different types of debt available, I can broadly classify it into three categories. One is asset-based loans, meaning that the lender will, of course, evaluate your business, but they actually lend with the expectation that if something goes bad, I will liquidate the asset that I have and get my money back. So they lend based on property or mortgage collateral. They lend based on equipment that is saleable. They lend based on stock that is saleable. Now, the key thing here for asset-based lenders is that the underlying asset has to have good resale value. That is number one. And number two is that it should, the amount that the lender has made a loan, the asset has to cover more than that. Meaning that if the company is not able to repay the loan, they have the ability to sell the asset and get the money. Now, one specific thing that I want to mention here is that while the value is important, the resaleability is even more important. Meaning that you may have a property of a very high value or an equipment of a very high value, but if the lender doesn't consider it to be resaleable, they will typically not make the loan. So if you are looking for an equipment loan or a loan against a property, you have to be sure that it is both resaleable, of course, both of good value and resaleable. Second type of loans is typically the transaction-based lending, meaning bill discounting, supplier financing. In these kind of circumstances, what happens is that the lender evaluates the counterparty, your buyer or your supplier. And if your buyer has a better credit rating, and typically the bank or the lender has relationships with them, they will provide the funding because they are kind of evaluating not you, but the counterparty. Similar with supplier financing. A lot of the times, the suppliers have better credit standing than the AgTech companies. In those kind of situations, the lender may be comfortable financing the supplier, which takes care of the working capital requirements of the supplier, and they don't demand money from you sooner. The last and slightly more modern option is the venture debt, which is a situation where a lender provides you with the money or the debt when you have a reputed institutional venture capital investor. They don't typically fund you when you are bootstrapped or you have an equity investor who is not considered reputed in their opinion. What they evaluate is the ability of the reputed venture capital equity investor to bring in more capital if the company needs the capital, or to crowd in more equity investors when there is a need for the company to get further equity. So here's the thing. I talked about three other options of debt beyond the type of debt that, for example, a Caspian Debt type of an organization provides. By evaluating the core business of the company, here are three other forms of debt, but as life would have it, the lenders do not evaluate the core business performance of the company as much. They do that evaluation, but they actually lend based on comfort of something completely different. Asset-based lenders lend based on the underlying asset. Transaction-based or bill discounting lenders lend based on counterparty evaluation. Venture debt providers lend based on your equity investors evaluation. None of these people lend based on your evaluation, which means that the amount, customization of the loan and the suitability of the loan may not always match your requirements, but they do meet or serve an important purpose and should be considered at different points of time. So to give you an example of some of the other, I mentioned the types, but to give you a little bit more details, what are they, and these would these other sources, for example, if you are selling through a e-commerce platform, or if you're selling on an electronic platform and your transactions are recorded, a lot of fintech lending companies provide loans up to 10 lakhs through a cash flow trap mechanism. Say you are selling inputs through an online platform, and the online platform has got into a tie-up with a fintech lender, and you need a small amount of loan, they can provide that. There are small business term loan providers as well, both on the NBFC side and the fintech side. They will provide slightly larger loans. Sometimes they do unsecured, but typically they will cap out at 30 lakhs or 20 lakhs actually. They expect you to be profitable. A slightly bigger amount of loan is available from the same people. Typically, the traditional NBFC is what you call a loan against property. And there, what they'll do is they'll make a loan based on 50 to 60% of the value of the property, nothing doing about the business. This is typically slightly costly. One other option that we have seen a lot of entrepreneurs use is take a mortgage loan if they have a personal property, housing property, from a bank, which typically comes at cost which is near home loan rates, near but higher, and they also get it for much longer tenor, and they take that money into the business. But this option is available only to those who have personal property, which is not the case in most first generation entrepreneurs that we work with, at least at the beginning of their startup journey. The other option is one very useful option is CGT MSC loans from banks, where loans or exposures debt up to 2 crores is available from banks. You don't need to provide mortgage collateral. You typically don't need to be profitable. You have to be an SME as per definition. And there are a few government related criteria that you need to match. The only trouble is that it's not very easy to get. It takes you a lot of patience to get to that. And the problem is that if your debt requirement in future goes above 2 crores, the same bank will not provide that amount of funding to you, because for a larger amount of funding, it is not covered by the scheme, this CGT MSE scheme. And for a larger amount of funding, the bank will go back to its normal method of operation, which is they will lend only with mortgage collateral and 3-year profitability. So these are the other options that you have, or that you can consider for different ticket sizes or different kinds of situations. If beyond the likes of Caspian Debt. So to end this, if I were to summarize, I would say this. I would end with these 4 points. So, building a strong business or an AgTech company is primary. Raising funds from external sources is actually incidental. If you should raise the funds from external sources, whether it is equity or debt, only if you believe that you are able to return the money, and because your business has the ability or is it strong to return the money. In some cases, of course, like using the money for R&D and developing new products, you may have to raise the money to make sure that you are able to develop the product. But typically, raising external money should happen only if you believe that you can return the money. Second, money is fungible. Like I said, equity and debt both give you money, but the usage of them and the expectations of usage of them are very different. And it matters because, in a way, the risks that both these capital providers take are very different, and their expectations are very different. And hence, the way you use the money, or what use you put the money into, that is something that you should be careful about. What interestingly, a lot of entrepreneurs come back and tell us is that for those who've actually been able to figure out this nuance, understand this nuance well, some people have actually decided that working capital requirements or cases where I will have immediate cash flows, I will fund only with debt. And for everything else, I will use equity. To the extent that some people have just kept aside money, even if they have funds for lying in the bank, they will not use it for working capital purposes. Some people are so specific. And entrepreneurs tell us that this clarity of being clear about why the usage of money is important has helped them build a more disciplined business, and it has helped them scale up better. The third point is that each and every investor or lender or grant funder, whatever you're tapping, there is a big universe of these people. It is not that everybody should be your target. You should do a little bit of a research on who is the appropriate type of a funder for a situation, like I tried to explain for debt a little earlier, and then approach them. Everybody has a different business model and risk appetite or a mandate. So for them, because of those reasons, you should not target everybody. And lastly, look for a partner especially in the early and growth stages, because in the early and growth stages, you won't always have a smooth ride, predictable ride. There are bumpy rides, and it helps if you have people who work like partners and you are not transactional with them. A lot of proactive information sharing helps. A lot of working together helps in the early and growth stages. Once you're larger, transactional relationships are fine to have. This is not to say that a lender will be okay with a default. The answer is no. But then there are chances of, if you are proactive, the lender can work with you and give you a little bit more time to help you to recover, or provide you with more funding to help you recover, or understand why there is a stress and try to help you with connects or references that can help you either raise money or get more business. So you should consider all these aspects when you raise funds. Before I end, what we will do is that I obviously could not cover all the details of the nuances of debt funding. We have created a handbook for entrepreneurs like you. We will send that out. I will request the ThinkAg team to share that with all the entrepreneurs in the audience and anybody else who's interested. If you are interested beyond this, please write to us at info@caspian.in. We'll be happy to share this handbook with you. That's all from me for now. Hemendra.
Thanks, Avishek. It's been a fabulous presentation. I think it gives a lot of clarity to all the entrepreneurs on when to use debt, when to use equity, and even on debt, I think you have given a very good framework in terms of how to go about it. So thanks very much, Avishek. Maybe one or two questions, if I may ask at this stage. I think even in AgTech, if you look at, there are two kind of startups. One is which are more focused on supply chain solutions, like building farm to fork linkages, or let's say building a direct to farmer model, essentially selling inputs. So that's one category. Another which is more like product startups, where we have, let's say, company working on robotics or image processing and stuff like that. And in the first case, you can predict some cash flows. In the second case, it's very difficult when you're in a product development cycle. So how do you evaluate these two cases? I'm sure there are differences in the way lender would look at it.
Yeah. So a very good question, Hemendra. So in fact, you're right. For the second case, where it's a product development company, it is difficult to gauge cash flows. And typically what we've seen is that at least in our opinion, it is dangerous for such companies to raise debt early when their product is not developed. It is more appropriate that they should, but what happens is that after the product is developed, they need to sell, and what what we've seen often happen is that a lot of these companies, once the product is proven, the pilot rounds have gone great, which is typically funded by equity, there is a sudden large order that they can't meet. And unfortunately, if debt is not available in that kind of circumstance where the sale is proven and the buyer is interested, if you don't raise debt there, you end up with the chance of diluting your shareholding by raising equity. Those are the kind of situations that when these kind of product companies should raise debt. And I think the good part, once they reach that stage, these kind of companies are more attractive for a lender because the margins are much better than the other type of companies that you're talking about. So I think there are benefits for a lender to work with both the companies at different stages.
Great. And the second question I have is, in case of venture debt, what kind of comfort do you seek with the existing investors? Are they supposed to give you some sort of guarantees, or what are those 2 or 3 things which you seek from them?
Yeah, so venture debt is one of the products that we provide as Caspian Debt, and that product essentially involves a small warrant or an options component. Typically, say 10 to 15% of the loan amount comes in as a warrant component or an options component, meaning that we will have some right to purchase some equity shares and sell it to make a higher return to compensate for the lower coupon. But that is one product that we offer. There is no formal commitment from the equity investor per se. It's more of, we evaluate the equity investor in that case and their track record before we do those transactions. But what we've seen is that venture debt only product may not be the suitable product in all cases of AgTech or all cases of the other sectors that we work in, especially because we are an impact-focused lender. That valuation uptick or the extra returns because of the valuation kicker, equity kicker, may not happen in all cases. So we've figured out a way that we make normal term loans and cash credit kind of revolving facilities for even companies that are loss making. So and that is where a lot of these additional evaluation based on the information that we get from the companies becomes important. So from that perspective, when a AgTech company is evaluating the options for debt, I think we have busted the myth that loss-making companies can only get access to venture debt with equity returns. In specific situations, the lender may be able to evaluate the risk and make a loan without taking warrants. But the information requirements are more, the interest rate may sound like more, or it may be like, initially the interest rates are lower, over a period of time it goes up and so on. Those kind of adjustments may have to be made.
Right. And Avishek, my last question is, you've given that to so many AgTech companies. Can you talk about your experience, or if there are any do's and don'ts? You talked some of those in your presentation also. But, if you have any suggestion for the entrepreneurs who are on the call.
Yeah, so I think the best people is probably the entrepreneurs, but I'll tell from what my perspective, what I've seen. I think the transparency of information, sharing information is something that is very positive. Proactively saying, whenever we talk to entrepreneurs, the typical conversation that we have is bad news has to come first. Good news can wait. If that approach is taken, I think it helps a lot. And like I was saying, for a lender, even if your technology is breakthrough, it doesn't matter beyond a point. What really matters is, yes, I appreciate as a lender that the technology is breakthrough, but can it generate cash 3 months down the line? What is going to generate cash 3 months down the line? Tell me about that. So I think that approach helps. Collections, focus on collections is very important. A lot of companies focus on revenues and never focus on collections. I think that's what we've seen successful companies do. I mean, to tell you the truth, we have worked with, we've been doing this for 7 years now, right? So just to name a few companies because it's out in the public. So we've been working with companies like EcoZen from the time they were like, I think 3 or 4 crores of turnover. We've worked with companies like Stella Apps, which again, I think we started working with them since the time they were like 3-4 years. We've worked with companies like Promethean. We've worked with, there are, like I said, there are 30 or 35 more companies that we've worked with. One common theme across all of them that we've seen is that the promoters understand clearly that working capital should be financed by debt, and they kind of compartmentalize it in their heads, making sure that they use debt or try to get debt from different sources to be able to grow by reaching out to all these debt providers and not just limiting to equity. So I think that approach also helps, and because of that they prepare how they'll share information, they prepare how their internal controls are, systems are, and I think that helps them grow faster.
Okay, great. I think there are 1 or 2 audience questions. I will request them to post on the chat box. Avishek, can you ask them to put it on the chat box?
Yeah, Hemendra, I have asked.
Or I don't know if they can ask the question. That's also okay.
Yeah, I can do that also.
Yeah, can you do that in the interest of time?
Yeah, Gururaj has raised his hand.
Go ahead, Guru Raj. What's your question?
He's on mute.
Guru Raj, are you there? Okay. I don't think we can hear him. So maybe we can take it offline. And with that, I want to thank Avishek. And now I'll request Arindam for his closing remarks. Arindam, first of all, many thanks from the entire ThinkAg team for making this masterclass happen. Request you for your closing remarks.
Thank you, Hemendra. Thanks for the wonderful presentation, Abhishek. Now, it's very, very important with the number of AgTech companies we have in India, more than 1,000, that different sources of capital are made available for the disruptions which is getting promised in the market. And it's very, very important from the demand side to also understand the different facets and nuances of different kind of capital. And I think Abhishek gave a very good definition, or helped us understand what a good capital structure for a company is, when to go for debt and when to go for equity. And that's critical. What we have seen in the Indian market, especially for small businesses, there's not a lot of knowledge about when to reach out to what kind of capital, and within that capital pool, which are the organizations to reach out to. The good part about India, and it's unique, I repeat that, in spite of all the financial non-inclusion story we hear, that niche organizations like Caspian and many others impact funds, which are there for health, education, agriculture, etc., which make a huge impact. Such an ecosystem is not there in other parts of the world. So it's very, very important to be able to understand the key and niche role they play before businesses become mainstream and large, to be able to engage with formal financial institutions. And the good part is there are multiple large organizations, multilaterals and others, who are backing a lot of these impact funds and niche MBFCs through different kind of products and large programs, and they are increasing the exposure to India and especially to agriculture and AgTech. We should hear about larger programs in the next 3 to 6 months being rolled out. And it's extremely important that on the demand side, we get it right on how to make ourselves, how to prepare ourselves to be debt ready, how to help the debt providers underwrite the risk. And the most important part, I think, was what Abhishek said in the last statement that new companies, nascent companies, disruptors should look for partners and not only for sources of finance, because a knowledgeable financing institution not only comes in with capital, but it also comes in with a lot of knowledge about the sector, knowledge about the ecosystem, with a large network, which helps the business to grow or to make useful connections in the sector to be able to do its business better. So thanks once again, Avishek. I think that was wonderful. And the devil is always on the details. We look forward to the handbook. And I'm sure it will be very, very useful for the entrepreneurs, not only in the AgTech sector, but across the technology sector, making impact to make India a better place to live in. And I would also like to thank Hemendra, especially Abhijit from the ThinkAg team, who did all the heavy lifting to get this together. And a big shout to all the entrepreneurs, all the very best, because capital is available. It's not only equity capital. And we are lucky, again, I say in India, that a lot of specialized capital is available through a lot of these niche and wonderful institutions that India has. And to be able to work with all of you, to be able to do the right kind of disruption to make agriculture more profitable, not only for the farmers, but also for the consumers and for the nutrition security of the country and the world. Thank you so much.
Thanks, Arindam. And clearly, Rabobank and of Caspian had a huge role to play in making that capital available to entrepreneurs. I think without your effort, I don't think we have reached this stage. And we sincerely look forward to those larger pools of capital, which you mentioned. I'm sure that will take the ecosystem to the next level. But thanks very much for all the good work that you are doing. And thanks to the Caspian team for partnering with us. It has clearly given a good direction to everyone. I am hopeful the entrepreneurs on the call benefited a lot. I hope, Avishek, you're going to get a few deals very soon after this call. So thanks very much for this support and participation. And I thank all the participants, all the entrepreneurs who are on the call. If you have any questions which is unanswered, please feel free to reach out to any one of us. And stay tuned for the next masterclass. We are going to announce it very soon. Thank you.
Thanks, Hemendra.
Thank you.
Thank you. Thank you.